Morning, everyone. Welcome to the room. As you know, trading futures does involve risk. It's not suitable for all investors. The information in the presentation is for educational purposes. It is not a trade signal service, not intended to be financial advice. Well, we're off to what looks like another good day. We've got a sizable gap down coming, and it looks like we'll be somewhere around the low of this swing low back on the November 20th. So it looks like 85s or so is where we're at, and the low of that swing low is 90.75. In yesterday's video, I commented on that being a very significant level because in the last couple of weeks, all we've really done is gapped up, pulled back, gapped up, pulled back, and the pullback has only been to fill that gap and then go higher. So I don't think this is necessarily the end of the bull run, but nice little pullback should stimulate some new buying because for folks that are sitting on the sidelines, they can utilize any larger pullback than normal as a justification for a good buy. You do have a lot of cycling out of stocks and closing out of positions this time of year. So for big hedge funds, that means if you have a hedge on against a position that you're like, let's say you're long of a basket of stocks and you've got a hedge in the S&P that is to cover any downside risk. Well, when you cycle out of those stocks and you close out of the actual big position, the long position, then a lot of times that can lead to either closing out of the hedge in the S&P or closing out of the long position and then putting on a hedge in the S&P as sort of a way to bridge the gap, if you will. So a number of things could be going on that lead the market to go lower. So it's not necessarily just putting on a new short position. Taking profits is also a selling proposition as well when you're covering along. So that being said, we've got room to move, and that's what we like to see. So I'm definitely going to be looking at the first 5-minute bar for a potential gap play. However, I'll need to see it be less than 4 points. I don't want it to be a humongous bar because I don't want to take on excessive risk just because the market is moving. You want to be you want to keep your risk contained. So there becomes a point where it's like just because the market is trending doesn't mean you have to go with the trend. You want to look at, well, how long have we been trending, and are we in a good spot to get in the trend? So we have broken the swing low in the pre-market. Let's see what else we can, or in the trading hours only now from the pre-market. And you get these bigger sell-offs in the context of an uptrend because the market has not really created much of a base. There's a little bit of consolidation here where you could kind of draw a horizontal line and see some overlapping of highs, midpoints, and lows. But other than that, we've pretty much just gone straight up since breaking through highs, and that would be about a 30.33. So the last swing low up to highs puts the halfway back at about 3,000, and that's kind of right at those highs. So a breakthrough highs. You can buy the breakout, you can wait for the pullback, and then buy the retest. There's lots of opportunities to get in when the market is punching through. And there's a good chance here that this candle is going to be pretty wide. Yeah, it's already about 8 points. So if you take the first 5-minute play today, just be aware that that 1 point stop is, unless the market punches through on its next candle and doesn't look back, you're likely to get stopped out. So that's the risk that you're kind of assessing. But we do have quite a bit of room to complete the gap, or we have quite a bit of room to fall to that 3,000 level, and then the least appealing scenario would be to just move sideways, create a lot of overlap with long tails and a market that's not really going anywhere. As we saw yesterday, the market did move quite a bit in the first 15 minutes and didn't leave much in terms of a trending entry. So that's the pattern to start the week, and it very well could continue into today. So first 5-minute bar is a nice little hammer, but it is bigger than 5 points. So technically it's a pass. But if you want to risk it, that I just know that I always keep the same stop size regardless of volatility, because just because a market's volatile doesn't mean that it's going to be sporadic or like very whipsaw. You could have a market that is a big range and not necessarily volatile and all over the place, and it could pull back into a really nice retracement and bounce beautifully. So you don't need to have a giant stop just because the range is wider. And I suppose that's better phrasing than saying volatile. I would prefer to say wider range or bigger range. I'm going to turn off the overnight. And now we can really see the gap down, and we'll be able to see more clearly what kind of price action we're getting here in the first 15 minutes. The overnight's helpful. I like to get a sense of where we went or what the trend was, up or down, but after first few minutes I kind of could do without it. See, and here's where you get kind of that peak above and not a super strong punch. And what I mean by that is, we broke above the first 5-minute bar, which would have, triggered an entry into a breakout play to get long, but then it wasn't backed up. It wasn't pushed through we kind of peak above and fail, as the phrase goes. And then, obviously, if you're going to have your stop below the low of the first 5-minute bar, well, now that's 8 points away, which means if you're going to just try to get 1-to-1 reward to risk, now you have to have your target out at plus 8 points just to get to 1-to-1. So there's a lot more to assessing a trade than just here's an entry. There can be good setups, but they also need to, you kind of need to find that balance between the numbers have to make sense to be able to place the trade with decent reward to risk, and it has to be a decent area with a good setup. You can't just have a big clean setup after the market has trended for 50 points in a couple of hours. So like yesterday, I was unable to get into the short early enough, or what I deemed early enough. So I kind of had to, switch gears, as I often do, and start looking, a step or two ahead. Okay, well, the short has kind of run without an entry point, and let me look for a counter trend trade that I can try to capitalize on. Another thing that I noticed yesterday, just kind of doing my evening homework, there weren't a ton of 52-week lows, which means a lot of the selling is probably stemming from stocks that are either at highs pulling back, not necessarily stocks that are tanking. If we look at things like Home Depot, that kind of led the pullback a couple weeks ago. And some of the stocks that you'd expect to be doing well now, like UPS and FedEx, are not looking too hot. Amazon is not near its highs. Apple did make a little double top up here and a pullback, breaking the swing low. Microsoft, not quite a double top, but breaking that swing low, the prior swing low that we always look for. So a lot of these bigger stocks are not really even making all-time highs, the bigger FANG stocks. On the 512, if I see this type of a double bottom with a lot of undulation in between it, like you kind of rally, pull back, rally, pull back, rally, and then pull back, rally, pull back. Yes, this is a double bottom, but what's more important to me is looking for like a break of a swing high over here. If this were to double bottom right here, like a bottom, a tiny bounce, and then bottom right here, that is a scenario I see and will execute on much more often than just having, two prices that are the same with a lot of time and space in between, if you will. Second bar is also fairly big and just kind of took back. So the first bar sold off, rallied, second bar sold off. Now the third bar here is rallying. So far it's been kind of a gap and flat. No major news on the economic calendar that I see today. We haven't really had and this makes perfect sense as you look at the 5-minute bar, haven't really had a halfway back that has got any sort of significant bounce here, so I wouldn't expect this halfway back short to get a bounce. If it does, then we should easily break lows. No low ticket lows, so a 30, we might not bounce before we break. 30, 80, 25. Short. 30, 80, 25 short. See if we get it. We just pierced through the 61.8 of the larger short, but if we fall, the other thing you can do is do a sell stop at 77s. You have that double bottom down here. You could put a sell stop one tick below that in case we punch through it. Now, yesterday we broke through lows by a tick or 2 ticks and then bounced. But if we break through lows today, after yesterday's sell-off, we may get more. We may get the 80, 25. There it is. We'll see if there's anything here. 80.25 needs to get to a 78.25 for a first target. We will see. It may just come up and blow through the halfway back short here and just keep chopping around. But if it's going to go down, yesterday we saw it go down early without much opportunity for any kind of entry. So we'll see. Definitely a little messy here. One more tick and I'll get that first target filled. There it is. All right, so I got the first target. Now, okay, now things are going to be happening fast here. Going to bring my stop down in the developing 61.8. Go with me here. It's going to be quick. 78.50s and dropping. Okay. Hang tight. I'm going to bring it down to 78s. And if this swing high holds, I'll bring it above that here in a few seconds. 75.25. There it goes. So stop 75.25 on the whole position. And if we drop quick and like straight down, then I'll take 2 contracts and try and trail each candle. But so far, I'm going to leave it 75.25. See what we can get out of it here. Okay, that's not doing anything for us. This is small, this retracement here. Oh, where was the target for that bigger halfway back? We're already at the negative 61.8. Okay, so next halfway back is above our stop. I'm going to take it down to 74s. That's a little tight, but if we fall, we should fall from here. I don't want it to go back up to the halfway back, the next halfway back if it, what did I say, 78s? So 74 is where I have my stop. No low tick. So when I mean the next halfway back, I'm talking about this. I don't want it to come all the way. I don't want to have to wait for it, wait in this trade for it to come up to 77s and give back, 5 points and then let it roll over. I'd rather be tighter. And here we go. All right, hang on. Could get a little wild here. Down to 72.50. 72. It's a little tight, but it's the most recent halfway back. That could be another entry if you're not in, but it's going to be fast. No low tick. All right, there it goes, 72. Well, not bad. I didn't think we were going to get the 80.25, but after not getting a fill yesterday, the market redeems itself today. So we can review that here in a minute. Let's just get a handle on this next retracement. So here was the first halfway back. See how we blew through the negative 23, the negative 61.8. So now if we go from that swing high to lows, it's going to be not quite a traditional, because we blew we went so far, the negative 61.8, we went past that. So I don't anticipate a 76 trading, but if we go lows to lows, we may trade the 61.8, which we do. So I'm just going to leave the drawing like this at 76s. If we get there, then I'll just do the same thing, look for a little short off of that level. I don't necessarily want to jump back in the direction I was just yet. Give it a little bit of time to breathe. And if we come back and check out our 5-minute pattern, we had sell-off, rally, sell-off, little bit of a bounce, and then here was the bigger sell-off, and then now the rally. So it would make sense to maybe make it up underneath to, I guess 77. So this 50 very well could trade. kind of the underside of what was support that David commented earlier about being a double bottom now should act as resistance. If it doesn't, then we should easily be able to break through highs on the other end. And let's check our daily chart, make sure we're not running into anything, which I know we're not because there's nothing to run into. Unfilled gaps. 3050 I have. Let me check my list. 30, 34. Yeah, 30, 35, 75. That's down here. I have 3050 written down. Is that here? That one filled. I didn't cross that off. So where are we at? 75. Yeah, we're not. There's not really a gap fill. Like yesterday, we came down to the gap fill and bounced right on it. I mean, 12s, and we came down to 10s. So we'll see if this gives us another short at the halfway back here. So far better than yesterday in terms of ability to get into the trend. Yeah, so looking at the last short, keep my eye on that guy there. We traded at a larger halfway back short. I don't even call that pierced the 61.8. It didn't really break it. It needs to break it by 2 ticks to be a significant break. We broke the opposing long and then came up into the next short. So the short after the larger short was the entry. And there was no low ticket lows, so that there was no signaling that it could be the low of the day. Okay, come back to that here in a second. Here's our opposing long. We either need to not touch it, like come up short, or break through it. And we've got, this is the most recent swing low. And all we've done here is double bottom. So I don't like the short yet. But you see what I mean about, like, there's a larger retracement drawn here, 30.76 and a quarter. That's the larger halfway back. You could see it on a 5-minute if I were to draw it up like that. And then when I come in on the 512, looking for the smaller setup to follow, like so. Breadth and advanced decline line are still looking good to the downside, especially the advanced decline line, 1650 to the negative. It doesn't mean it can't change. I'm looking for a shift in the breadth and the advanced decline line to go from minus 1600 to minus 15 to minus 1000. So yeah, so see, it's helpful to really use that swing low, and when, like, the swing low here, it didn't break, it kind of double bottomed, and then when we come down within, just like I'm looking for like a 2-tick break of the 61.8, coming within 2 ticks of a halfway back, it's kind of like saying it traded. It came so close that the longs are in play here. So then that's why I pass on the short. Sometimes you can pinball between the two 50%. back and forth. In this case, we've just come up and broken this halfway back, but remember, it's not the full halfway back for the day. So let's go back and, well, I have it drawn on this one, the full. I can grab it. 77.88. So even though we broke this short, see how, and this is the trouble you run into when you have a larger halfway back that breaks through its negative 23, through its 61.8, the next halfway back using the entry point that occurred around the prior 50%, as I have it drawn here, this area for like the upcoming entry can get very messy and hard to trade. So I always keep that in mind as I'm zoomed in, in here on the 512, knowing that, okay, things could get a little bit messy. And that was the long I wanted, but whoops. So let's get rid of a couple of these. Let's adjust this to be the full halfway back short. And now we can see we rallied off lows, pulled back almost to the halfway back long, rallied a little bit more, broke the swing high, pulled back to its 50% at 76.50s, and are kind of bouncing now at the full halfway back for the day. And all of these candles have been pretty sizable. Got another 30 seconds till the first 30 minutes close. No, let's see, we had a 48 low tick, and the low price of the day was at 50. So no low tick at lows, which means we could make new lows on the day. There's no definitive low tick at lows. I don't count the first couple minutes of nicey tick readings because you get some swings right at the open, or just it can be a little bit polarized. So just I ignore the first minute or two, and then I'm not exactly sure how to code it so those wouldn't show up, but I just kind of ignore that part and give it a few minutes. So here, same thing, came up, just barely pierced the 61.8. So there are other, so I have $ TICK, the nicey tick. There are other ticks that exist, like for the NASDAQ and for the S&P. $, the nicey tick was the original that's been around for the longest time, and it's, to get the larger basket of stocks, same with the breadth and advanced decline line, those numbers are based off the nicey. So to get a bigger picture of 2,500 stocks versus just 500 is the reason that we use nicey breadth, advanced decline line, and nicey tick data. But if you were trading the NASDAQ, or there is a NASDAQ, just put a /Q at the end of it, and you get the NASDAQ tick. Okay, since this halfway back is right at the swing low, I'm going to get rid of it, and now we have a little bit bigger break of the halfway back, but we're already back down to the 50% and showing pretty strong breadth and advanced decline line still. This would be a little bit risky. What did I say that failure was? Yeah, right there. So now we're kind of right at the 61.8 of the next long and at the larger halfway back. So it could take a few minutes here to kind of settle out. You get these mixed signals in these areas. That's why it's helpful to not just draw up a level on the 15-minute or a 5-minute chart and put your order like, say, 30, 77, 50s. One, you've got a bigger distance between the 50 and the 60-1/8, but letting the market, come up, test the level, and get a little bit of a sign that there's something there before getting in. Yeah, middle of the range too. So if you look at the high and low for the day, and now that our first 30 minutes have closed, the market is sitting right in the middle of the range. So it doesn't mean that we can't develop into a trend. There's no need to take excessive risk when you have, trade setups like the one 15 minutes ago where you get in, first target hit, and it drops like a rock. So the 78, 75 is getting some little bit of traction here, but what do we have for a target? 30.65 would be, so here's the halfway back short for the day, pierced at 60.18 a little bit, but no low ticket lows, so we could still go lower. I think setting a target of 4.5 points, 3-1, as a fixed target is a fine idea. If you have one contract, just having a target out there, and then all you're doing is managing your stop. So you have the target at 4.5 points. You're in the trade, and you're just tightening your stop, and then all of a sudden, once the trade hits your target, then you're out. With one contract, you're kind of limited to your exit point. So the goal is not to make a bunch of money with one contract. It's to learn how you handle being in a live environment with real money on the table with the least amount of risk you can take with one contract. So that's a great idea. I also find it beneficial I encourage people to practice with multiple contracts on your practice account so that when you do make the shift from 1 to 2 or 1 to 3 in the live environment, you have experience trailing your stop at either multiple exit points or getting out at multiple exit points. And sometimes it's just beneficial to practice that for the sake of managing your trade ladder and making sure you don't make mistakes. So getting a little sloppy here. If I get rid of the 78 short and draw up a high to low, you can see we've broken its 60.18 here as well. Kind of getting sloppy, meaning we're going through the 50 to the 61 and then kind of rolling over, breaking the lows by a little bit, but not quite making it all the way to negative 23. And as Stan commented earlier, right in the middle of the range, that's a very common characteristic. And if I come down and draw the opposing long, we're getting mighty close if we're not already there. Like so. And I made the comment earlier about pinballing between two 50%. That's kind of what we have here. I can even get rid of this retracement because we got the 50 short above us and the 50 short, 50 long below us. Oh, no doubt, John. Two contracts is a huge, huge difference. I think one contract is the hardest to trade, and no doubt two, it feels like, wow, this is so much easier. You don't get that mental push and pull of, okay, do I trail my stop or do I set a fixed target? So I like Stan's comment about having a fixed target at 3-1, at 4.5 points, and then trailing your stop at the same time to kind of squeeze your way towards that target. And hey, 4.5 points with one contract is not, is not too shabby at all. And so you kind of take out some of the psychological strain, but then when you get to two, boom, you can have one first target at 2 points, lock that in, cut down your risk, still have a contract to trail. Now you could still have a 4.5 point target for that second contract and trail the second contract at the same time because, I mean, let's be real, two contracts still isn't going to make you $1 million. So the idea is to, with 1, 2, 3 contracts is to build the skills in a safer environment that's not going to cost you a lot of money. You can do some serious damage in a good way with 2 and 3 contracts. I've had plenty of $500+ trades with 2 and 3 contracts, and I spent probably a good year and a half or two at 2 and 3 contracts. And yeah, that's a good spot to be in to get that rhythm. And as you are in that zone, more than 1 but less than 4, so right in that 2 to 3 window, you can really do a lot of good to your mental game if you're practicing the things that we talk about with trailing like having an exit plan that you use and execute the same way on every trade. Okay, I'm going to use a first target, I'm going to trail, and then my third contract, I'm going to be conservatively trailing. And or even with let's go back to the 4.5 point target, you could have for 3 contracts a 2 point target, a 4.5 point target, and a trail. That's just having that laid out is really the key. So we've broken the halfway back short by a couple of ticks. We've broken the halfway back long by a definitive margin. And now 76.25, I'm not going to blind limit that, but that would be sort of the point at which getting short would be advantageous, starting to develop a triangle, which is common in these range-bound mornings where you spend some time in the middle of the range, you sell off a little bit, but then maybe you make it back up. And just by retesting this halfway back short, you can see how we would put in a lower high. And if we back out, there's really not a lot of, you've broken the trend line here. So a triangle down here could go either way still. It's not like we're developing from a wider range. All we've done is broken the uptrend line here like that. So case for the downside, definitely. But with the unfilled gap above us at the hour mark, so in another 15, 20 minutes, is when you would typically see, if we're going to bounce it, that's where it's going to happen. So the 76 trades, it touches, I should say. Yeah, the hourly. I mean, if you consider Friday and the Wednesday half day, Friday, and then yesterday's sell off, that's kind of the poll for the bear flag. And then today is, I mean, even yesterday alone, the poll and then the flag, and then today gap down, likely to be kind of a sine wave in S by the end of the day. And then I wouldn't be surprised going into the end of the week if we get a lift and push back up. So 76 touches. It doesn't trade through though. I find that the early trades are, even though they're not as developed, like the trend isn't quite as developed and clear, I consider them a bit safer than trading in kind of this kind of a mess in the middle of the range, for sure. And as you get later in the day, you get more people who are emotionally invested, and various algorithms and computerized trading platforms that are using data that has materialized from the morning. So you can get more back and forth and get kicked out of trades more. At least that's what I found back when I used to trade in the afternoon. So I don't do that anymore. So you can definitely see the triangle now. And we know that we gap down. So again, that being the pole, the move down, the typical outcome to a triangle pattern is in the direction of the pole, so down. But being a gap down, if we get lift, so far it's been kind of two bearish candles, a stall out, one bearish candle, two bullish, two bearish, and we've still got 4 minutes for this candle to close. So not really a pattern in the candles themselves. We did take all of the down move in one candle and two candles to take it back, and then two candles to go 2/3 of the way. So market is easier falling today. Has had an easier time falling than rallying, which is typically what you see. Big down moves, and then the up moves take quite a bit longer. I mean, even on the most recent daily chart, you get these quick down moves, and then the up moves take longer. There is well, I won't get into that. We'll save that for next week. I'll be sending out some more info this week on next Monday's master class. I know most of the folks in here are going to be attending. That'll be Monday evening Eastern. If you If you can't make it, send me an email and we can get you a copy of a recording. And I think I've got one more spot available to attend live. I'm trying to keep it to 20 so we can contain the discussion and kind of keep things manageable. And that'll be all about trading the 5-minute ES. All right, so broke the swing high right here. And that's kind of the start of the failure of the triangle. It's a small triangle, kind of a 3-point, 1, 2, 3, apex, and up. So we kind of need to reestablish a retracement that holds from the swing from this low to highs if it's going to develop an uptrend. Meaning we just need to pull back to a halfway back long and see it hold. A high tick here. It's not the high of the day, but it did occur at 17. So back here. And then we made wasn't the high price, but we did make a higher price after that. Advanced decline line came in a little bit from 1600 to 1400. And the breadth too. Was it 5, -5, and -5.5 at one point? Now it's only -3.5. So a slight shift, but still within the range. We want to watch as we come up to the high of the day, 86. See if we come up and touch it and are met with selling and we can short and fade it, or do we come up on a really strong move and break through it, in which case, buying a pullback or a breakout would be the way to go. I do take this time to run kind of. Typically for my swing trades, I put the orders in just before the open, just kind of schedule them or know what orders I'm going to be putting on and get those going close to the open as the market's breaking down or making its move. I don't do much trade management other than at the close. One trick I'll use when we're making new highs, I think I mentioned this last week, is to only add or scan for stocks that have made new lows in a very bullish day, because on a bullish day you're going to get a couple hundred stocks that made new highs. So it's more useful to just scan for the lows and add those on the strong days and vice versa. Then you have less to go through. And they're the ones that are truly opposite, relatively weak. I tend to start yeah, so I will, like, let's say on a day like here on, what was that, the 27th or the 26th or the 25th, where the market is making new highs, I won't do a 52-week high scan on those days because I know I'm going to get so many stocks that are making 52-week highs, but they're likely being brought up with the rest of the market. Whereas on a day like yesterday, where we have a big down day, I want to know what stocks made new highs as the broader market sold off, and those are the ones that I want to be a part of. Yeah, we've got a very micro long here on this double bottom. The market is basically on top of what would be the entry at a 78 and a quarter. It's a little bit too small, but I'm watching it here. I would guess that we go up to the halfway back short or make it up to like an 80 and then sell off and be in the middle of the 250s, kind of like what we just saw. But remember, we're still in a range. We're still between the high and low of the first 30 minutes. So since the first trade today that's short, things have definitely become more choppy, if you just want to use the broad term, and not as definitive. And I'm okay. There's, in a lot of cases when we're in this kind of situation, I'll just wait for us to break the higher low or come up to the higher low so that we can short at highs or sell at lows, kind of fade the range. Yeah, very good spot to stay away from, as Robert comments, getting chewed up in the range. So with swing trades, I'll trade up to the week before Christmas and then pretty much get flat and stay flat into the new year. Yeah, I'm looking forward to. Yeah, it definitely makes taxes cleaner. Same with trading futures. Makes it much easier than options and stocks and cost basis and all that. I am looking forward to next week's masterclass. So I got the idea from actually the Traders Expo. I always get asked to do, or I have been asked to do longer speaking engagements. I guess what they would call a masterclass in the live show. So normally I'll do like an hour-long educational presentation, but then they also have kind of these private smaller classrooms where I think they charge an arm and a leg for them too. So it's not free like the expo. And to have a presenter come in, a trader come in and do a course. So I wasn't able to make it to the Vegas expo this year. So I thought, oh, maybe I'll try doing the masterclass kind of virtual, and then we can go through and have a small group just like we would in person and try it out. And so if it works well and if people like it, and then pairing that with a follow-up session, 30 minutes where we can get together one-on-one, answer some specific questions or hash out anything in a little follow-up. I thought that was a good pairing. So if it works well, then maybe I'll do another one next year on swing trading or a different topic, or hold the E-mini futures, do a master class once a year, or we'll see. But I think it's going to be very informative, useful, and definitely very actionable as we kind of close out this year and go into 2020 to set you up for the new year. So this is exactly what I was anticipating, or not necessarily afraid of, but the situation where you come down to the 50 long, come up to the 50 short, break it barely, just pierce it, come back down to the 50 long, and don't really get an opportunity to take a long setup because you have both of them in play and you're within the first half hour range. So kind of sounding like a broken record, but it's those kind of patterns that you see throughout the day and throughout the week. I mean, even on the daily chart, the pattern of forming a new high or gapping up, pulling back, filling the gap, and then repeating that we've been doing that for a couple of weeks. So that kind of stuff, you start to pick up on that. You can actually act on it intraday and make trading decisions off of it. That becomes really useful practice of finding these kind of patterns. So I'm going to sit tight until we either get closer to the high of the day or just peter out here. Then when I go through my list of stocks, I'm always comparing everything to the S&P. Okay, that's what the S&P looks like. Well, then when I go to Microsoft, oh, it's basically the exact same chart. And then if I go to, Amgen, oh wow, that looks actually stronger than the S&P. So that's one that I want to put on my radar for a potential long, maybe above the high of today's candle. The market gap down and is bearish, and Amgen is actually showing strength. And you get these situations where you have these hammers. You can buy above the high of that hammer on the next day and then ride the wave just by trailing your stop underneath each daily low. You can catch a pretty good reward to risk ratio. You have your stop below the entry candle's low. It's pretty cut and dry, which is why I really enjoy swing trading and always have. All right, question on drawing from 72 to 83.50. Let's look at it. So 72, it's where I've got 83.50. So that's the drawing. Oh, maybe the question is, why do I have it drawn like this from the swing low here as opposed to lows of the day? And whenever we are in a triangle, and this is the apex, right where the cross of my cursor is, I like to go from the swing low just before we break at the apex, break at that converging point. So that puts it here to, in this case, highs. You'll also see me, if we break, let's pretend that this is our halfway back short for the day. When we break that, I will take sometimes a trade that has a swing low just below the 50. Now this is in the other direction, to just above the 50 and take that halfway back on the 512 tick chart. It sort of engulfs the 50 and the 60-18 in the other direction. So the bigger setup was a short, and I would be taking the long. So that's a play I'll do too. Yeah, falling back down yet again. starting to develop a solid uptrend, but more of a ascending triangle where the highs have been the same. But we're not close enough to highs to fade it. Like I wouldn't come in here at 982s and try shorting. But over on the 512, you can kind of see it where you got the highs lining up, the higher lows. But not, again, in the middle of the range, so not really an actionable spot. I mean, you could take action, but you end up getting chopped up, and having a couple of losers is not helpful to your P&L. Not that losers are necessarily bad in themselves, but in the context of where we are at, it would have to be a very, very good-looking setup to take a trade within the context of the range here. But feels like we're getting close to breaking out. So I don't look at the VIX on an intraday basis, but I will keep my eye on it. And again, relating that to the S&P, whoops, if we look at, okay, here we have the VIX spiking, and it hasn't quite made it beyond its beginning of October highs. And then if we look at the S&P, and we know we're at the negative 23, so I'm going to get rid of this. And if we look at S&P, beginning of October is over here, the lows. It's definitely, I mean, our pullback here is much less than the VIX rallied as it relates to the beginning of October. And so just getting an idea of, is the VIX breaking down and the S&P going down as well, which would be very odd. Typically they're inverse, but I look at it to relate to the swing highs and lows that sort of align with prior. Typically, it's sell-offs. So like on the beginning of August, we had a big spike, relatively big spike in the VIX. And if we go to the beginning of August, we can see the drop that we had in the S&P. So looking for things to line up or converging indications. Another step of higher lows and right up to that top, but not really any kind of pullback until we make it to the halfway back long. So that's why I say there's not really any actionable trades in here, because there's no pullback to sell. I mean, aside from just putting a sell order near highs and trying to get filled that way. Same with the daily and weekly chart. I'll look at it more in depth on Sunday night, Monday, and then as we come to kind of the intraday, then doesn't change so much on a day-to-day basis, so I don't need to do a ton of analysis. And even my morning routine for the ES, it's very simple and only takes about 5 minutes. So I don't spend a lot of time preparing like a bias for the day or doing a bunch of analysis to try to pick the direction for the day, because all that can go out the window in 2 minutes. I'd rather have an idea of, okay, what am I going to do if the market goes up, down, or sideways, and make that my framework for each day. This has become a very common question, and I'm glad I have an answer. So the question is, how do I get the two charts? So I've got a 5-minute and then the 512. When I do a drawing over here on the right, it's not showing up on the left. And if you come down, if you're in toss, bottom right corner of your chart, drawing set. So the one on the right is called default. Well, if I make the one on the left default also, boom, all those lines show up on that chart. So if you come to drawing set and do create new and call it something different, so I just call this one unattached, now I can make a drawing over here and it only shows up on a chart that if I make drawing set and I call it, or if I check unattached, it would show up. And I like that because I can have some things on one chart without on another for obvious reasons. But if you want to be on a daily chart and see, or like if I'm zoomed in here, so if it's helpful if you've got multiple screens or multiple charts that you don't want to redo the drawings on each one. But since I toggle through, if I draw something on my chart here and then I want to go up to a hourly chart, obviously it's going to stay because it's the same chart. So I don't mind toggling through 5, 30-minute, hourly on the same chart. It just keeps less on the forefront of my screen visually. And so now a little bit of a break of the uptrend line here. If you were to draw it from kind of the low portion of the bodies, I like to go for bodies as opposed to the tails, because the body is either an open or a close, whereas the tail is just a temporarily stopping point. So like here is a tail, but it's so close to the body that it's And with trend lines, any kind of trend line drawing, close is close enough, so you don't have to get exact. Stan asks about if you're going to take some off at a first target, is it better to do, or some might prefer doing half off, half of your position off at the first target. So with two, obviously it's one off at the first target and one off at the whatever swing or whatever trail stop you're going to use, or second target. But then if you go to three, now you're an odd number. So do you take one off? Do you take two off? I like odd numbers. I like intervals of three because you're only taking a third of the position off at the first target. And so it leaves more of your position to be reaped under the bigger win. If you have the small win as your 2-point first target and the bigger win is like the larger portion, I'm okay with coming away with a scratch trade or a small loser or a small winner, versus if you go to four and you take two off at the first target and then trail two, yes, you're in a free trade, or the chances of you're get that first target hit quicker, so you're in a free trade quicker, or you're at break even quicker, but now you have a smaller percentage of your position to trail. In the end, I don't have stats of what would it look like if I've taken even numbers versus odd numbers. That would be probably pretty difficult to do, but I guess not too difficult, but you just have to assume some variables that would be variables. So, but I personally prefer to do 3, 6, 9 contracts and take a third of the position off. But if you can trade four, if you're comfortable trading four, there's nothing wrong with taking two off at the first target, even having a 4.5-point second target for your third contract, and then your fourth contract trail. The idea is you want to look at each individual contract as it risk to reward for the contract itself, because you could fall in the trap of saying, well, I traded, I made $1,000 on that trade. Well, did you trade 2 contracts or did you trade 10? And $1,000 P&L with 10 contracts has a much smaller R multiple than 1,000 contracts with, or $1,000 with 2 contracts. So I'm more, I really don't care when someone says, oh, I had a $50,000 day. It's okay. That's great. If you traded 100 contracts, I want to know what's your R multiple. If you trade 100 contracts, it's not that impactful. If you traded it with 2 contracts, it's also probably not that impactful because I'm not interested in catching a one-off spike after a Fed meeting announcement. I'm interested in repeatability and long-term sustainable growth. So in the end, it really doesn't matter if you trade even or odd numbers, 3 versus 4, and it doesn't really matter if you take half the position off or only a third of the position off. Just remember that the goal is to stay in the trade as long as possible, a winning trade, stay in the trade, a winning trade, as long as possible with as many contracts as possible so that you can have the biggest reward to risk possible versus getting in, getting out, getting in, getting out, plus 1 point, and doing that 5 times a day. Every time you put on a new position, you open up new risk. So like with my swing trades, if I'm flat and all of a sudden there's 5 swing trades that pop up, that's 5 times the risk that I have on at once. If I have 3 trades already on and I've tightened my stop, maybe I've got a first target hit, or at the very least, been able to bring my stop up. Now if I put on 2 more trades, okay, I still have 5 trades on, but my total risk is much smaller. So that's something that really doesn't get talked about too much, or I don't know if many people look at that, but that's a very important piece of, like, when you start being more of a portfolio manager and like that as a trader, it's not just about getting in and out of a trade. You want to be sort of all encompassing, your own portfolio manager, if you will, and those are some of the things to think about. Well, I don't think we're going to get anything outside of this first 30-minute range here in the next couple of minutes. So gap and crap, at least for the morning here. I wouldn't be surprised here if we turn this into like your traditional day where it ends up being kind of a sine wave. So we could dip a little bit lower and then kind of rally into the close. But usually, not always, but whatever direction we move after the first hour's range. So if we were to make a new high on the day, we, in very rare cases, if an hour has gone by and we make a new high, do we come down and break the low of the day? I would maybe 25-30% of the time that occurs. So more, and then that's kind of the sine wave phenomenon. So like yesterday, here's the first hour here. We broke down and then we didn't break the high of the day. Let me see if I can find somewhere it did. Here we broke the high of the first hour. So I'll go to a hourly chart. That would make a lot more sense. See if I can find an example of that. So like here's the first bar. We broke down. We did not break the high of it. Here we broke down and we just, I don't know, it doesn't really count, kind of closed. Here we go. On the 20th was a situation where we broke the high of the first hour and then rolled over, and look how hard we dropped and then broke the low of the first hour. And so those moves can be really harsh and strong. Your typical day, you don't see that. Here's the first hour. We rallied off of the low and then broke to the upside and then continued to the upside. Here's another one where we broke the high of the first hour and then kind of fell like right away and then broke the low of the first hour and then resumed. Here on the 13th, broke the high of the first hour and stayed above. So the actionable, and so here again, if you break, so to make it actionable, if you break one way, so like on this day, if you break to the upside and then come back down into that first hour's range, like expect a pretty good decline to the other end of the range. And you see that same thing for the first 30-minute range. If we're kind of at the top of the range, if we break out of the first 30-minute range, when we come back into it, there's a good chance we can fall pretty hard to the other end. So today, we're just stuck in the middle of the range. And that's a sign to call it a morning. So very triangle-esque here on the 30-minute chart. We'll see what the rest of the day brings. It could slide to the downside and drift lower into the afternoon, but I would expect again kind of that that sine wave, kind of like we had yesterday, down, up, down. That's the sine wave shape that you get. So not a bad day. I mean, a nice trade right off the open, and then things kind of shifted a little bit, and were a little bit sloppy and didn't really see any good setups after that. So take what you can get, and sometimes it's just one and done, and that's all right. So thanks everyone for tuning in today. Appreciate it, Robert. Thanks for the kind words. And if you are interested in the master class, shoot me a note. Tim@eminimind.com. I can either get you hooked up with the recording afterwards, or I think we're right at 19 when I checked yesterday evening. So I'm going to try to keep it at 20 so we can have a manageable conversation, go through questions, and then follow that up in the next couple weeks with some one-on-one sessions so I can answer any individual questions that folks have. So, but as always, you can reach me at tim@eminimind.com, and happy to help. So thanks everyone. I hope you have a great week, and I will talk to everyone very soon.